Welcome to the final lesson of this series. So in this lesson, I'm going to show you a real chart example, and I'm going to take all the information that we've learned in the previous lessons and apply them to an actual real life chart. Now, I have taken the euro dollar 15-minute chart here as an example, and I'm using the replay tool. This will be the best way for me to teach it, right? Now, I could have cherry picked something and gone for a really perfect market maker model, but in reality, you're not always going to find a perfect market maker model, as you are probably aware by now if you have gone through your charts and back tested, right? So, this is one of the first examples that came up, and it's on a 1 minute time frame, so this would be ideal for a short-term intraday trader or a scalper. Again, don't forget that price is fractal, so this can be applied to any time frame. Apart from time of day where we get into kill zones and stuff, everything else is going to be similar, right? So we have the 15-minute chart here in front of us on the euro dollar. Now, I am delineating this high as our old high. This is where buy side liquidity rests above this high in the form of buy stops. Now we can clearly see that the higher time frame is bearish. The likely draw is below these relative equal lows down here. Now, if you recall back to the previous lessons, I said that the market likes to kill two birds with one stone, right? Now, in this example, we have the buy side liquidity resting above this high, and above it, we have the remainder of this sell side imbalance here. So there's a little portion of that sell side imbalance left open over here. So this is going to be the buy side draw on liquidity. We're anticipating price to reach higher before it goes back lower, attacking the sell side liquidity below the lows down here. So what has already happened? Again, I'm not teaching the PD arrays in this series. So if you would like to know more about them, then please head over to the website and check out the academy. Now, you can clearly see how we have rejected from the rejection block, and then price has stayed above it. We've created a higher low with this candle, and we have found support inside of this order block. We can see how the candle bodies have stayed above the mean threshold. We can see price finding support, and we've already witnessed a break in structure above this high over here. Again, this is a part of the model found in the actual academy, so I will not be reteaching that over here. If we move over to the 5 minute time frame, this is where we can set the stage and we can get into a little bit more detail, right? On this time frame, it doesn't look like there's an imbalance in this area. This is why it's very important that you have the higher time frame levels marked on your chart, right? Now, there'll be buy side liquidity resting above these highs. This will be our point of origin, and our expected theoretical terminus would be the buy side liquidity above the old high and as far as rebalancing that 15-minute fair value gap. We do not need to fully rebalance that 15-minute fair value gap. The low hanging fruit objective would be the buy side liquidity above the old high. If we zoom in onto this area, you can see how price ran the sell side liquidity below these relative equal lows and back into this down close candle over here, which is an order block inside of a higher time frame order block. The mean threshold level is being respected and price rejects from this level and we push up higher, reaching our terminus. Now let's break this down further. We have ran the buy side liquidity above these highs with this candle here. And then we have run the sell side liquidity below these relative equal lows with this candle here. This gives us our initial dealing range. We are observing this at the beginning of the Asian session. This gives us our dealing range high and our dealing range low inside of our initial consolidation. You can see how we've ranged back and forth. All of this range is inside of this dealing range high to this dealing range low. We have our equilibrium level, which sits at the midpoint between the dealing range high and the dealing range low. This is our initial consolidation. You can see the relative equal lows at the dealing range low. This is engineering a pool of sell side liquidity below these equal lows. At equilibrium, we find our high probability order block. After price has left the initial consolidation, we've seen an expansion higher with displacement and then a retracement back into equilibrium where we find our high probability order block. Once price has touched the order block, you can see how it's rallied higher and swept the buy stops above the old high. Now let's get into the 1 minute time frame. So this would be our entry time frame. We have our point of origin down here, and we have our terminus in the form of the buy stops above the old high. At this stage, the buy program is complete. Notice how we ran up into the consequent encroachment of the remainder of that fair value gap. And if you notice the bodies, they're stopping dead at the old high. The bodies tell the story and the wicks do the damage. In this case, the bodies are not willing to go deeper into the remainder of that sell side imbalance left on the 15-minute time frame. This is an algorithmic footprint telling us that price is no longer willing to offer any buy side. From the point of origin to terminus was our buy side delivery range, or our BDR. If you recall, the way we measure our BDR is we take the dealing range high inside of the consolidation to the dealing range low, and we project deviations higher. In this case, 1.25 deviations gives us a high of 1.08753. And we can see how we came very close to that level, which sat above the old high. So this would have been a fairly good target for us. Now, if you look closely, since price is fractal, we actually have a smaller consolidation inside of that larger 15-minute dealing range. If we take the manipulation leg, which ran the sell side liquidity to the left, and anchor a fib from the high to the low, and then project deviations higher, we get 2.5 deviations, gives us 1.08753. Again, the same level as the previous deviation that we had calculated. Now, notice this is between 2 and 3 standard deviations, where we are already anticipating a reversal. Inside of this range, I am looking at these two up close candles. From this range low to this range high would be our breaker range before the manipulation. If we take the breaker range high to the breaker range low and project standard deviations higher, we also get a deviation of 1.08753. So we have three different ranges giving us the same price level, which all align above a buy-side liquidity pool and a higher time frame level. We can also see how price has returned back into that breaker, which overlapped with our 5-minute order block and the equilibrium of the initial dealing range. This is where we find our first stage of accumulation. Notice how the bodies of the candles fail to close below the mean threshold of this breaker. We have also run sell side liquidity and into a small fair value gap in the form of this buy side imbalance, which also nested at that equilibrium level. This stage of accumulation is also in a discount relative to this range low and this range high. You can see the high of this up close candle comes in at 1.08754, which is 1 pipette of the 1.08753 level that we had found confluence at. So just 1 pipette of the exact high. Of course, we'll be calculating our graded ranges and deviations before price prints, right? So our theoretical terminus would have been the buy side liquidity above the old high. We would grade the range from the point of origin, which would be these equal lows down here, to our initial terminus. To speed things up, I'm obviously showing you the printed range of that buy side delivery within the buy program of the market maker sell model. At 25% of the graded range, you can see our first stage of accumulation. Notice where we have our stage 2 of accumulation at the 75% level of the graded range. Notice the reaction from stage 2 to terminus. We have rebalanced this small buy side imbalance and rallied higher, completing our buy program into our terminus level. Note that when we left the initial consolidation, price never came back to fully close this level. This became our breakaway gap, which also rested around that 25% level. After the breakaway gap, we had a common gap that was formed, which was completely rebalanced when we had our first stage of accumulation. Generally, after a common gap is rebalanced, at 50% of the range, we have our measuring gap. You can see here how this buy side imbalance has been left open. Since our buy program is now completed and we expect a change in state of delivery for a sell program to commence, we now wait for confirmation. If you wanted to take a turtle soup above this old high and into the consequent encroachment of the remainder of that sell side imbalance on the 15-minute time frame, which also had confluence with our 1.8053 level, that would be perfectly acceptable. But if you want to wait for further confirmation, then you are waiting either for a structure break or a change in state of delivery. Our terminus has now become our point of origin, and our point of origin has now become our initial terminus. The range between our point of origin and our terminus on the sell side of the market maker sell model is our SDR, or our sell side delivery range. If we take the swing low to the swing high that ran the stops above our second stage of accumulation, this is our manipulation leg. If we project deviations downwards, we get a deviation price level of 1.08631, which rests below the equal lows. So as an initial terminus, this would be a good objective. If we take the breaker swing from this candle's high to this candle's low, yes, I'm ignoring that wick, but there were reasons, and that's beyond the scope of this presentation. If we project deviations lower, we get a deviation of 1.08633, again in close proximity to the last deviation, and again below the equal lows of the initial consolidation. So this again would be a suitable target. Now, for the sake of time, we can see how our sell-side delivery range had printed, taking us back below the equal lows and completing our sell program. But how did we get there? When price ran back below the open of this up-close candle, this was our change in state of delivery. If you notice the bodies, how the algorithm was just marking time by keeping price inside of this range. Now you would see this more noticeably on a lower time frame. The change in state of delivery happened when we ran through it here with the displacement below the opening price of this up close candle. We broke below this low with a down close, leaving the fair value gap in the form of this sell side imbalance, buy side inefficiency. Since we broke market structure with a down close and we had displacement in the form of this sell side imbalance, this validates the break in market structure. Price has traveled back up into that fair value gap, which overlapped with the tail end of this bearish order block. This would be our low risk sell entry. Now, notice how we didn't fully rebalance to the premium high of this sell side imbalance. That's because on the left side of the curve, we're looking at this buy side imbalance. You can see how we reprice to the premium end, since this whole range now becomes a balanced price range. Price does not need to fully rebalance this sell side imbalance, since there is a balanced price range below it. We now have a breaking structure below this swing low with a down close, with a fair value gap that has been left inside the leg that broke structure. This would have been a higher probability breaking structure, since we broke below the second stage of accumulation. We have swept sell side liquidity below this low, and then price has returned back up into this down close candle, which is our breaker. Inside of that breaker, we have this fair value gap in the form of this sell side imbalance. You can see how price has traveled higher inside of the fair value gap, rejecting from the consequent encroachment area and touching the discount end of the breaker. Now, why did we not see price fully rebalance this sell side imbalance? Because if you look closely to the left side of the curve, we have this buy side imbalance in the form of a balanced price range. So price did not need to return higher to completely rebalance this inefficiency, since we had a balanced price range below it and we had the discount low of this breaker. This is our first stage of distribution. We have ran sell side, we have run into a fair value gap, and we have mitigated all at the same time. We then have another break in structure with another down close below it. We have a small fair value gap that price has traveled higher and rebalanced. Again, notice the bodies. We also have this up close candle, which is our bearish order block, validated by this fair value gap. We also have this buy side imbalance, which now acts as a balanced price range and an inversion level. And you can see how price is respecting the discount end of that level over here. The body's again telling the story that is not willing to go any higher. This is our second stage of distribution and would be our silver bullet entry. Price then really sinks lower, clearing the sell side liquidity below these lows. In this market maker sell model, there is engineered sell side liquidity below these equal lows. The algorithm then has repriced higher, sweeping the buy side liquidity above the old high and tripping those buy stops into active market orders. Smart money will then pair these orders with short positions. The algorithm will then reprice back below the initial consolidation, and the interbank traders will offload their sell positions that they paired with the buy stops up here and offload those positions to the willing sellers below the equal lows. After our high probability break-in structure below the second stage of accumulation, we have our breakaway gap, which is only partially filled here. We have a small common gap after the breakaway gap, which is completely filled here. And then below the common gap, we have a measuring gap, which has remained open. Notice how this measuring gap on the sell side of the curve overlaps with the measuring gap on the buy side of the curve. If we take a fib and anchor it from the range high to the measuring gap, and we project one standard deviation lower, the very low of this candle comes in at 1.08632, which is the same level that we get over here, 1.08632. Stage 1 and Stage 2 occurred above equilibrium of this sell side delivery range. We ran the sell side liquidity below this low, and we ran the sell side liquidity below these equal lows over here. Now, this was a very shallow sweep, so there's still a large pool of liquidity resting below these lows, and the bodies of the candles haven't traveled below this low. Usually when this happens and we've had our stage 1 and stage 2 in the upper 50% of the range, this usually indicates that price is going to probably go lower. We see that we have a common gap that has again formed after the measuring gap. The candle's bodies are staying below the consequent encroachment of this gap. If we look to the left, this last down close candle on the buy side of the market maker sell model becomes our distribution block. And again, you can see how we're mitigating inside of this distribution block, inside of the common gap that has been formed on the right side of the market maker sell model. Ultimately, price rejects this level and rolls over in a series of 1, 2, 3 drives lower. If we go back to the initial manipulation leg and we anchor a fib from the low to the high and project deviations lower, between 2 and 3 deviations, we get a midpoint of 1.08600. If we take the very low of this candle, it comes in at 1.08601. So just one pipette off the actual low. And again, within 2 to 3 standard deviations of this manipulation leg. So when we blend all these things together, you can see how the market maker models can be extremely precise. Essentially, this is how the whole market is booked on buy and sell programs. A buy program will run into a sell program, and a sell program will run into a buy program. Tracking this constant ebb and flow of the market will allow us to search for the highest probability trade setups. We will be able to distinguish where we are inside of a buy or sell program. Using the range deviations, coupled with higher time frame key levels and areas of liquidity and inefficiencies, gives us targets where we can anticipate price to reach for. Again, understanding the higher time frame draw is essential when utilizing these market maker models. Understanding how we can grade a range and where our stages of accumulation and distribution may form also gives us a higher probability to enter a trade. If we pair inefficiencies on the left side of the curve with inefficiencies on the right side of the curve, we can often find the balanced price ranges, which will form dynamic support and resistance in the market. We can use our breakaway gaps and our measuring gaps to distinguish where we are within the accumulation or distribution cycle. Now, I know it looks relatively complicated, but the more you practice and go back through and journal, back test and study, you will begin to train your eyes in seeing these things in price yourself. There are always going to be slight variations between brokers, so the exact high and low can sometimes vary by a few pips. But if you stick to these principles, you can get very, very, very close. I will be going into more detail and doing many, many more examples throughout my mentorship program. Of course, I may or may not still be running the mentorship program by the time you watch this video. But if not, I implore you to go through your own charts, create a study journal, and really dissect each of these concepts in order for you to train your own eyes to see this in price. Remember, always try to keep three different time frames where you have your higher time frame draw, your mid time frame stage, and your lower time frame entry and stop loss placement. Everything that I have outlined in this example is directly taken from the lessons within this series. You may need to watch each video a few times. So with that, I would like to say thank you for watching. I hope you have found this series useful, and hopefully it has made the market maker models a little bit more clear for you. This has taken me many years of sifting through all of ICT's content to understand that this is what he is actually teaching us. So again, thank you for watching, and I wish you all the best in your trading career.